and welcome to Investors Hangout. This fortnightly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. With me today is Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
Now, over the past few days, what has happened is that returns from long duration debt funds, they have fallen and entered the negative terrain. And obviously, this has worried the investors who prefer fixed income funds because of their non-volatile nature. So, why really is this happening?
It's happening because interest rates went down last year, and now there is an apprehension that the outlook for economy getting normalized, or we are so interest rates might go up, and if interest rates might go up, that's a reason to worry. That's why yields go up, which means prices go down. And whenever interest rates will go up, these bond funds will take a hit. Right now, we are witnessing that just the worry that it might happen is causing this much of decline. If we have interest rates really going up, one could be in for a bigger surprise. So you have to worry about it, but you should not forget that take a holistic view. Last year we had double-digit return from these debt funds, the long duration funds. Also because successive rate cuts, which came which came after this crisis, but it was completely unexpected. Nobody thought that it will happen. Also, one should not forget the scale. One should not lose the sense of proportion. Debt funds are meant for fixed risk averse investors, but even in the bad situation, even if people are disappointed, it is down 1.5%. It is nothing like equity. Equity is far more volatile. You see big declines, big gains in a brief period of time. It is nothing like that. So I would say that we are coming to a phase which started last year after the crisis, that interest rates have stopped going down. It may go up once again, and this is the anticipation of going up which is causing this ripple. And the reality might, as and when it happens, investors will be in for a sustained negative return. But I think most investors can do without it.
Okay, now considering that the return on gilt and long funds have been falling, lots of investors have also been asking that, if the correction has already happened, is now the right time to invest? What do you suggest?
No, it's not. It may not be the right time to invest, because the right time to invest in a long duration fund is when you see, or you're sure, that interest rate will definitely go down. And this does not look like a situation that interest rate will go down substantially and further from here. It might go down a little bit, maybe, if economy doesn't pick up, or the situation remains grim, but it is unlikely to go down dramatically from here, and the likelihood of interest rates going up is much higher, and that will cause a far bigger decline in the value of these debt funds, the long duration funds. So this may not be the best time. In fact, if you are invested, be prepared for a decline or get out of them.
And what about the risk-averse investors? What should they be doing?
They should be into medium-term, corporate bond fund, or other options, the short maturity fund, shorter-term debt fund, because you may not get great return, and I don't think this is the time to expect great return from those investments. But not losing your money and getting a modest return is good enough, and that is what people should aspire for. One has to be extra cautious with such, selecting your funds, because trying to optimize your return through a debt fund, which is investing dominantly into fixed income securities of companies and shorter maturity government bonds. One should be careful about quality of those, because you invest in a corporate bond fund and the underlying company stops giving money, or you are unlikely to, the fund does not get the principal and interest on time, and we have seen quite a few instances of that kind. So one has to be a little careful. Also, it is not that those companies will default. The fear of a default can also cause a decline in the value of those investments. So one should be a little more careful, and I think the worst may not be over.
Okay, time now to move on to viewers' questions. The first one has been sent in by Ashok, who is a retiree and wants to move his money from fixed deposits to debt funds for higher return, but is scared of the recent crisis. How can he mitigate the credit or default risk is what he wants to know.
Be into higher quality bond funds. So if he's considering to invest, in debt fund, consider fewer options and very high quality ones, and there are options available. The returns might be lower than the outliers, the best performing fund, but that's okay. Options to look could be banking and financial services fund. It could be high quality corporate debt fund, and also short term debt fund which substantial investment in AAA and sovereign.
Okay, now Shantanu asks, would you suggest investing in dynamic bond funds as the fund manager is free to choose between durations?
Theoretically and ideally, yes. But I haven't come across too many instances where fund manager has been able to do the gymnastics well, changing its course depending on the rate outlooks. And maybe right now investing in a dynamic bond fund might be useful. But in the past, in last 4 or 5 years, whenever things changed, it came as a surprise, and most fund managers were unable to anticipate that. So maybe it's worth taking a bet and look at a fund which has been able to do it well in the last 2-3 cycles. And there are few funds which have been able to do it well. So be selective. One has to be very careful with choosing them.
Okay, Rati Jason Fernandez wants to know, given the low home loan interest rate of around 6.7%, would it be wise to invest in second house property?
6.7% is going to be the cost of your borrowing. But buying a property comes with all kind of extra attention that it requires. You have to look for a tenant, and it's going to be a property. You have to see what is going to be the rental yield. If you are buying a property worth a crore of rupees, what will be the return on that, and what will be the cost of your borrowing? So it requires careful arithmetic, and also one should not forget that when you buy a home, it is a depreciating asset. It might be appreciating asset over a period of time, but will it actually beat the inflation? Land prices do go up, and they don't depreciate many a times. So it depends on all these circumstances. Generally, my idea, my suggestion to any naive small investor is that be off from that. It requires attention. It's a big ticket thing. You can't diversify, and this is going to be a liability of 6.7%. And don't be pleased with 6.7%. These are all floating rate interest, so it might go up when interest rates go up.
Plus the condition of real estate industry.
That itself, that's something, I'm assuming that you're going to buy a property which you'll definitely get.
Yeah, okay. The next question has been sent in by Aziz Ahmed, and he asks, is the 1 lakh rupee exemption from long-term capital gains available to all categories of mutual funds?
No, it's only on equity mutual fund, and only on equity mutual fund which are invested 65% and more in equity. And there is another thing to check that funds which will levy securities transaction tax when you redeem. So that is the definition of a equity mutual fund. And 1 lakh rupee, because debt funds and all other funds which are not part of this, they'll be liable for the standard taxation, holding of 3 years, holding of 2 years, indexation, and it will be treated as a capital asset. So it's not all that bad. And this 1 lakh rupee exemption is only for the equity as well as equity funds. I would also like to point to that right now we are coming to the end of this financial year, and a lot of people might be worried about this, is that the long-term capital gains will be levied only on your gains subsequent to 1st of February 2018. All the gains prior to that is tax exempt. So you have to do this careful calculation, and if you need help, just come to Value Research, put your portfolio, and we will tell you what part of the gain is tax exempt, what part of the gain is taxable.
Okay. Now Nitin Sagar wants you to explain the relationship between bonds and stocks. Is it an inverse relationship, he asks?
Theoretically, yes, but stocks in the short run can behave in such a weird manner that this inverse, you just might be waiting and it may not happen in a hurry. So theoretically, yes, because interest rates go down and people think, the assumption is that because the incentive for taking risk is so low, that people end up taking the equity risk. But many a times we have seen that this may not, this period can prolong. Theoretically and academically, yes. Practically, many occasions it doesn't happen.
Okay, now K. Kandasamy wants to know, would it be right to say that liquid funds are meant only for corporates and high net worth individuals, or is there any benefit for retail investors as well?
As of now, looks like yes, I agree with you. Earlier it was possible, it made some sense for individual investors. For your surplus money, idle money, there was a possibility of getting 8%, 9%. No longer. The way we have seen the decline in returns from liquid fund, it's no longer possible to earn more than what your savings bank account will give or nothing meaningful. And in fact, there are many banks which are offering more than what you will get from a liquid fund with absolute certainty. So in that sense, the case for liquid fund for an individual investor is over.
Okay, Barun Kumar Singh asks, are index funds a good choice for long-term investment?
Long-term investment, one should be investing in equity. Now there are different ways of investing in equity. You invest in an index fund, you invest in an actively managed fund if you are able to choose one, or you invest in shares directly. So these are three ways of buying equity. And there could be many other vehicles. You go to a PMS, this, that. But for individual investor, these are. So this, if you have no other skill, and you want to invest in index, long-term investment should be equity, and index fund could be a good starting point.
Today's last question has been sent in by Vikas Mishra, who wants to know, which is the best time of the year to invest in lump sum in NPS?
It is not a good idea to be investing lump sum anyway, and NPS should be something which should be a planned affair. But if it happens to be that you haven't made your NPS investment, and now few days are left, or you are hitting the March 31st deadline, that might make the lump sum investment, and then next financial year, make a planned regular investment.
Well, that's it for now. Thank you, Dhirendra.
Thank you.
Thank you to all our viewers. Do keep sending us your questions and keep watching this space for more information. Bye for now.